Harvey's got hedge funds caught in a whirlwind. Just after the storm triggered the biggest rush to a more bearish stance on West Texas Intermediate crude since 2007, they flipped the switch and raised bets on a rebound as refiners in Texas whip plants back into shape. Short sellers saw an advantage to be gained from the impact on refineries, but when it turned out it was going to be very short-lived, they made their way to the exits. Harvey led fuel producers to shut down more than 20% of American refining capacity as it made landfall on August the 25th, causing a sudden slump in crude demand and prices. But several refiners such as Valero Energy Corporation, Citgo Petroleum Corporation, and Marathon Petroleum Corporation got plants back on their feet in just a few days, stoking a post-Harvey rally. Some, like Phillips 66 single quote S. Sweeny and Exxon Mobil Corporation, S. Beaumont, are taking a little longer. Hedge funds increased their net long position, the difference between bets on a price increase and wagers on a drop, by 15% to 169,985 futures and options in the week ended September the 5th, U.S. Commodity Futures Trading Commission data show. Shorts declined by 7.3%, the most in 6 weeks, while longs rose by 3.3%. A week earlier, as Harvey's torrential rains flooded southern Texas, the net long position plunged 42%, the most since 2007. You can afford, as a speculative investor, to get a little bit more bullish, with crude trading below $46/barrel during the Commodity Futures Trading Commission report week. To Mike Isner, an energy analyst at Nasdaq Incorporated in New York, the storm certainly was bearish for West Texas Intermediate, but not for the long term, so why not make a quick buck? The U.S. oil benchmark traded up 0.8% at $47.85/barrel on Monday as of 10:22 a.m. London time. Now the focus has turned to Hurricane Irma, but there are still question marks around how it will affect crude demand. It isn't seen as wreaking as much havoc on the oil market as Harvey. Harvey was a big deal for the energy industry. It disrupted refining operations and it also disrupted imports. This one will be much more typical. It won't have the same effect as Harvey did on energy. Money managers increased their net long position on benchmark U.S. gasoline by 79% to $65,680, the highest level in more than 3 years. During the report week, gasoline prices rose to a 2-year high. The net bullish position on diesel also advanced. You want speculators to drive up the price of gasoline to encourage refiners around the world to supply it. You want to tell refiners not only in the United States, but also in Europe and Canada, if you can make it and get it here, they're going to pay you for it. To get faster updates and the latest news from the oil and gas industry, please subscribe to the YouTube new video channel and connect with us on Facebook, Twitter or LinkedIn.